What's up, guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to take a look at Palantir. They reported earnings, so I wanted to give you an update on that, as well as give you my Palantir stock price prediction for the end of 2021 and 2022. I also wanted to give you my thoughts on where I see the overall company going, as well as the overall stock price. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Hit that little bell notification so you can get updated or notified every time I post. There's also a link down in the description to my Patreon account. Come over and join the family. We would love to have you. Come be part of the Day One squad. You'll get access to the private Discord where we talk stocks. You'll get links to 5 portfolios so you can see exactly what I invest into. Anytime I buy or sell a stock, I send that out as soon as I do it. And then anytime I've got a watch list or I'm mapping out a chart or I see a nice opportunity, I send that out so we can grow our portfolios over there. So if that's something you're interested in, if you want to be a part of the Day One squad, I'm big on family. We would love to have you. Day One squad, you guys know that I love you. Your support has been unbelievable. You have no idea how much I appreciate it. Guys, let's jump in. So I want to talk Palantir today. There is a ton of people, talking about this stock right now. The overall sentiment in the market is really positive from what I can see. You get on a site like Seeking Alpha, it's just article after article after article of Palantir. And, same with YouTube. I've honestly seen some pretty outrageous valuations out there, on some of these YouTube videos and articles. I've seen people placing, $1 trillion valuations within the next 2 to 3 years. And, there's not very many companies that have achieved $1 trillion valuation. I'm not saying it's not doable. It's very doable, but that's high. That's a big valuation there. I still think that there's a lot of room for opportunity, even if that $1 trillion valuation isn't quite met, right away in the next few years. The other thing I wanted to say is, I think there's a lot of, overall bulls out there in the Palantir market. There's also, a lot of, bears out there in the market. So I wanted to kind of address some of those, concerns and positives on both sides, give you my price prediction, give you my overall thoughts on the stock. So let's jump in. All right, guys. So the first thing we can check out here is the earnings report they posted back on May 11th. As you can see here, Palantir reports 49% revenue growth and $117 million in free cash flow. Guys, that was one of the biggest bear arguments in the last, few months since Palantir went public was they were not profitable. They had no free cash flow, and that was going to hold them down for a long period of time. They would never reach that point of profitability. So the fact that they just reached positive free cash flow in the last quarter, it was a record-breaking quarter for them. That is really nice to see. As you can see here as well, the U.S. commercial revenue grew 72% year over year, which is fantastic. I think there is a lot of opportunity in that commercial space to continuously grow that. Palantir really has 3 almost stages of their business process. Sales process is a very important part of any business process, especially when you've got a service like they do. When you're talking straight commercial clients, commercial revenue, that first stage, a lot of the time, they do a free trial. They'll go and reach out to these conglomerate companies, give them a free trial to go in, use their software, see how it works. Once they do that, they can then grab that client and get them on for a extended contract of a year, 2 years, whatever it is. I use a lot of different softwares in my company. We use, CRM systems and lead generation systems and all these different systems. Most of them have free trials. We just used a project management software not too long ago. We signed up for the 30-day trial. I tried 3 of them out in like an 8-week period. Good thing we did that because we found the ones we didn't like really quick. And so I see that as a positive. It's a negative on Wall Street because, analysts don't like when they do that, when they bring a client on and give them a free trial because they're not making money instantly. But that's a good part of the process because it's gathering, building, and integrating them in with these clients. Most of the time when let's just say they give a big commercial company a free trial to their product. Well, their product uses machine learning, evaluates what their data is, and learns as it uses it more to find more effective and efficient processes. When you've got a company like that and they use your software over a period of time, they use it, they put data in, it learns their systems better, and it can be really challenging to switch that to another provider. So I see it as a good thing. They're losing money up front for a short period of time to get them on a longer contract to make money down the road. Like I said, if they can get integrated with these big companies, it'll be very challenging for these big companies to transition to a different platform in the future, because it'll consistently learn, it'll consistently improve, it'll also make their processes better. Now, the second thing here is the U.S. government revenue grew 83% year over year. The government revenue is big, guys. There is cons to government revenue, but there's also a lot more pros than cons, and I think it outweighs any of those cons. They have been very successful with the United States government, which is going to open them up to potentially market and onboard a lot of other governments globally that are allies of the United States. So I see more growth in that government revenue sector for years to come. Now, like I said before, the free cash flow from operations, or cash flow from operations, of 117 million, up 440 million year over year, and representing 34% margin. The adjusted free cash flow up to a 44% margin. Now, let's kind of take a look at their guidance. So guys, I wanted to show you a couple of things here. So for Q2, they're expecting 360 million in revenue, representing a year-over-year revenue growth of 43%. Now, look at this right here, guys. Adjusted free cash flow in excess of 150 million in Q2, so or full year, excuse me. So they're again expecting to stay cash flow positive. But look right here, annual revenue growth of 30% or greater for 2021 through 2025. So for the next 4 years, they are guiding to do 30% revenue quarter on quarter on quarter on quarter. That's fantastic, guys. There's a lot of SaaS companies out there in the market. Not a lot of them are growing 30% a quarter on a multi-billion-dollar scale. It is really, quite easy to grow at 30% year over year when you're doing low, under 100 million or 100 million in revenue. When you're doing it on a multi-billion-dollar scale, because they're really projecting 4 billion annual revenue by, I think, 2024 or 2025. So really great growth there, guys. And if they can keep that up while also continuously bringing up that bottom line, staying cash flow positive, that could be fantastic. Couple things here. And then I wanted to give you a couple things. 2.1 billion in net cash they've got in the bank. So that can cover them through any rainy days or poor quarters, down quarters, that they need to kind of have some extra cash on the side to complement a lower end quarter, because the way that their system works, like I was saying, they will do those free trials. There may be some quarters where they kick out a lot of free trials, and that quarter should have been the best quarter because they brought on all these new deals, but it shows a lower numbers or figures because they didn't collect revenue on those free trials yet. That will then show up down the road. They call it deferred revenue. So very nice. Also, Kevin O'Leary, Mr. Wonderful, picked them second for his, I want to say they call it the stock draft. It's like a thing they do every year where they, a bunch of famous people pick stocks to perform. It's like fantasy football, but for stocks. Now, the other thing I wanted to say is, so what I did is I put together this spreadsheet last night, guys, because there's a lot of people out there saying that the valuation's too high or whatever it is. What I essentially did is I grabbed 8 different tickers, companies in a similar type industry. Some of these companies don't do the exact same, but they're all SaaS platforms. They're all, software as a service. Some are different than others. I'm not really so much worried about what they do right now. I'm more so wanting to look at A, the rule of 40, and B, the price to sales multiple, to see how Palantir stacks up to the other competitors in the industry. Now, for those of you that don't know, the rule of 40 is a standard, very key metric for essentially measuring SaaS companies or software companies, growth to profit percentage, because you could have really, really nice growth percentage, but if your profit percentage or gross margin percentage or free cash flow margin is really low, then, that's obviously not a good thing. On the other side, you could have really nice profit margin or free cash flow margin. But if your revenue growth is really low, that's not good either. So what the rule of 40 is taking your revenue growth, adding it to your, either gross profit margin or your profit percentage, profit margin, or in my case, in this instance, I used the free cash flow margin. I think free cash flow is one of the most important metrics, so that's what I chose to use. Now, on the rule of 40, guys, I just did it on each of these companies' last earnings report, so the last quarter that they reported. Some of these companies, their fiscal years do not line up. We'll talk about that in just a second. But as you can see here, guys, Palantir had the 48.8% revenue growth in their last quarter, and the free cash flow margin of 34%, coming in at a total of 82.8%. So the standard is 40 for the rule of 40. You want to see them around 50. That's like your standard, just like the standard PE ratio is 15. The rule of 40, you want to see them at 50. As you can see with CrowdStrike, they are one of the highest other than like Zoom at 112% for their last quarter. Now, SPLK, theirs was negative 5.83%. But look, you can see here, they did almost the highest revenue other than Salesforce, CRM. Now, Snow was 121%. They are one of the highest as well. But overall, Sumo Logic, C3AI, CRM, Salesforce, Palantir is in the top 3 out of these companies that I've chosen here. And there's obviously a lot more SaaS companies out there, but I felt like these are some good ones to compare them to. So they are in the top 3 at 82% on the rule of 40, which is fantastic. They may have a higher multiple than some of these other companies, but when you look at the rule of 40, next to the price to sales ratio or the multiple, you can kind of see why people are willing to pay more for certain companies that have either a higher rule of 40 or whatever those metrics are and growing quicker. So as you can see here, these are the price to sales ratios based off of the stock price. Now this is the 100-day EMA stock price because I was going to use the price to sales ratio based off of the 100-day EMA just to give us a more average price to sales, because the big sell-off recently has brought stock prices down so low that I felt like it might be better to look at the 100-day EMA price, but I just decided to go with the price today. As you can see here, guys, this is the multiple, the price to sales multiple. For those of you that don't know, real quick, how to find a price to sales multiple is take the share price times it by the shares outstanding. That will give you your market cap, and then divide that market cap by your revenue for the trailing 12 months or your next year estimate guided revenue or whatever, if you want to get a forward or a current or whatever. Now, as you can see here, the multiple for Palantir is currently 25 at a price to sales metric. Now, and this is for 2021 revenue. I forgot to mention this. Some of these companies, they've already, reported Q4 2021 earnings. Their fiscal year is done for 2021. So some of these companies, I used their 2021 revenue. The other ones that haven't, reported their full year for 2021, I used their guided 2021 revenue, for those ones. As you can see here, guys, the average out of all of these are 31.3% price to sales ratio. Now, some of these are a lot lower, as you can tell. CRM, 9% or 9 times price to sales, but their rule of 40 is a little bit lower. Now, obviously, CRM is a much bigger company, with 21 billion in revenue in 2021. So, much bigger company overall. But as you can see here, CrowdStrike, their rule of 40 is way higher, and they're getting a 46 times multiple. So they're getting a higher multiple. SPLK, they're only 8. So that, at first may look a lot lower and a lot, more undervalued or, inexpensive, but they have a super bad rule of 40 percentage. Same with Snowflake, 112. Well, 120 on the rule of 40. So guys, what I'm trying to show you guys here is I don't see it being that overvalued. I see the multiple pretty in line. I mean, it's under the average out of these 5 companies, which I, felt was some of the closest competition. I think that you can award them a 25 or 30 multiple on price to sales because of this, because they're in the top percentage of the rule of 40 and they're right in line, if not a little bit under the average for price to sales ratios within their direct competition. So you are going to pay more for growth. In my opinion, I think there's a couple bear arguments we're going to go over. But in my opinion, the overall sentiment in the market will eventually change. As of right now in the whole market, high multiple stocks like this are not getting awarded. Share prices are way down. But overall, as time goes on, if they can hit that guidance to grow 30% quarter over quarter over quarter for the next 4 years, eventually that sentiment will shift and they will be awarded for that growth. So as you can see here, based off the 25 times price to sales, my price target would be $26.51 for before the end or at the end of 2021, and then $34.53 by the middle to end of 2022. Now, guys, let's take a look at the chart. Let me go over real quick the bear arguments real quick. Some of the biggest bear arguments out there right now is stock dilution. Okay, inside selling and stock-based compensation. Guys, in the industry like this, your employees, your people are your number one asset. If you do not have good people, your company will die. Now, stock-based compensation is one of the best, most pure ways to incentivize and reward your employees for doing a good job. Now, there's a lot of companies out there that do stock-based compensation. Their stock-based compensation, if it keeps up where it is looking like 4% a year, right? That's a lot of dilution there. But with that being said, a lot of the other companies that do similar things have enough revenue coming in that it overshadows that. So if we get some nice rally in the share price, it brings the overall sentiment back. I think that overall revenue, income coming in, growing free cash flow will outweigh that stock-based compensation, bear argument or issue. I also think that the more that they can award their employees, the bigger reward they get, the better the company is doing. So it's not that big of a concern for me. Obviously, you got to be wary of that and you've got to watch that. But I do think that if they can continue on the path they're on, that could just get overshadowed as time goes on. The next thing is the insider selling. Guys, this company's not brand new. They may be brand new on the stock market in the last few months, but they've been in business for like 17 years. If I was an insider in that company, I would absolutely sell some of my shares and take some profit, make some money, because I haven't been able to do that for 17 years or whatever it's been. So that is obviously a concern. Anytime you see insiders dumping shares, you've got to be wary of that. But overall, at this point, guys, it's not that big of a concern for me. Obviously, I'm going to continue and watch it, but I think this company is a long-term play. They do not care if you buy their stock. They honestly, I don't even think they're so focused on profitability right now. I think they are more focused on building their network, getting more clients on, getting more customers, integrated with their service, and expanding. I don't know if you guys saw my other video that I made. I will link it right here about a month ago, where I kind of speculated on those two investments they made on like Soros Robotics, the 2 SPACs that came public with the vertical takeoff, aerial vehicle company, and then also the robotics company. Well, it ended up playing out, and they ended up doing the contract with them and getting their services to use their software. Last thing I want to say, guys, before we look at the chart, data is literally one of the most important commodities we have right now. You want to talk plastic, wood, oil, whatever it is, gold. Data is single-handedly one of the most important commodities on the planet right now. There is not a single business-to-consumer company out there selling a service or a product that is not using or needing data. Data mining is the most sustainable mining you can do. As time goes on, We need to continuously find more about our customers, how to target them better. It helps companies be much more efficient, much more effective. So with that being said, I am very bullish on the overall sentiment of data mining, even though I'm not a huge fan of it because I hate when they mine my data on my phone, but it is what it is. So guys, with that being said, you got to understand how important data mining is within the, overall B2C, industry and the government industry. So now let's take a look at the chart, guys. Those are my overall, thoughts on the company. I think the stock is going to do very well. I think there is some concerns out there that you've got to be wary. But the fact that they just reached cash flow positive, I don't think that the multiples are that high. And I do think that overall they can get to a point where they will do very well. So as you can see here, we have mapped some support and resistance levels. As you can see here, ran clear up, traded sideways, straight up, straight down, straight up, straight down. And really has just been kind of selling off, trading in this range for all the way back until about, end of February. Did get pushed down right here, right at the beginning of May through that, support level that it was holding right here at the, the bottom of that gap, clear back in November. One thing I wanted to show you guys right here, look at every single time it comes up on the 20-day moving average. It just gets shoved down like a brick wall and cannot break it. Well, it is coming up on that 20-day moving average right now, and it looks like it is getting close to breaking it. But overall, we've got some red candles yesterday and today that could imply that it's going to get shoved down again. So you want to make sure you watch that. But this big bullish engulfing candle right here is looking really good. As you can see, you almost had an inside down and then right back up, went down, gapped up, and started pushing forward. What we really need to see this stock do is come up here and make a higher high, higher low, higher high, higher low, and really get back above those moving averages and get back into an uptrend. As you can see here, guys, you're going to run into some resistance right here. But, if you can break this and get up over the moving averages, this is not a bad spot because then you're going to retest it as support. So really what you want to see it do is come up here, break, come back down, retest, come back up, break, retest, come back up, break, retest, and start it, continue advancing. Last thing I wanted to say here is with the moving averages, you can see every time it touched it, boom, big jump, came down, touched it, got back above, boom, jumped up, touched it, boom, jumped up, and then fell below it. So I do think that once we get over those moving averages, get back into an uptrend, you could see some really nice moves back up towards the upside, especially where you've got these pretty defined resistance levels that are, decently spaced out. Once you can break through 25, you're going to 31. Once you break through the 31, then you're going to, come back up here and retest these levels up here around the $38 and $39 range. You had a little bit of bullish divergence back here, not much to really be, excited about. But again, guys, not too bad looking. I think the price point down here was a lot more enticing around the $17 range. That's probably why you saw a big bullish engulfing candle. It didn't sit down there for very long, but it did come back down here and retest this level right where it gapped up or, ran up violently back in November, and it is now using it as support. So with that being said, guys, I've owned the stock for quite some time. My average cost is around 19, 20 bucks. I added a little bit more in my brother's portfolio with him, back when it was like $18. But my average cost is around 19, I want to say high 19s. I plan on continuously accumulating the stock as I go on because I do plan on holding it for the next 2 years. I think if they can continue to do what they're doing, the sentiment will change and the stock will be rewarded for that. So that's it for today, guys. Let me know down in the comments what you guys think. If you guys have a price target for Palantir, I would love to hear it. But this video is for entertainment purposes only. I am not a licensed stockbroker. Always do your own research and due diligence. Come join us at the Patreon. We would love to have you. Love to be a part of the family. And I will see you guys in the next one. Peace.